Pay for performance is no longer a punchline. That's according to a new Hay Group Wall Street Journal analysis that shows investors have more influence than ever over what public company executives take home. At 51 large companies, more than half of CEO compensation was tied to company performance in 2012. 3 years earlier, at the same companies, it was 35% of pay that was performance-related. Wall Street Journal's Scott Thurm is waking up early with us in San Francisco to share the details. Scott, thank you so much, Scott, for coming in.
Morning, Ralph.
All right, so we're not just talking about a bigger portion of pay that's coming in the form of stock options, which everyone always said ties CEOs to performance. What kind of performance benchmarks are we talking about here?
So there's basically two kinds. The majority of these are two kinds. So either they'll give you, the CEO, a bunch of shares and say, you don't get it unless our earnings are, hit a certain number. Or they give the CEO a bunch of shares and they say you don't actually get the shares unless our stock outperforms this other group of companies. And if our shareholders are doing better than they would get by just putting money in the market, then we'll give you these extra shares.
Okay.
So those are the two primary ways that the two primary types of performance conditions that companies are putting on these stock grants these days.
There are a few examples in your story about CEOs that really have paid the price, so to speak, for poor performance. One in particular is Michael Splinter at Applied Materials, the semi-equipment maker. They have a particularly interesting pay scheme. Tell us about it.
Yeah, so they gave Mr. Splinter 500-some-odd thousand shares of restricted stock. But in order for him to actually get those shares, Applied's operating margin has to be better than the companies it competes against, or this group of peer companies they've created over 4 years. And so he has, on the one hand, it's sort of a stringent condition because he's got to, their profits have to do better than other companies. On the other hand, it's sort of this rolling 4-year target where he keeps getting another shot at it. So in 2012, they missed the target, so he didn't get any of the shares based on last year. And he can earn some of them this year, and he can earn more next year, and still more the year after that. So we'll see how these things work out in practice. But it's different that the companies are even attaching these conditions in the first place, rather than just handing out the shares, which is sort of what was more common five years ago or so. Okay,
another CEO is at Air Products and Chemicals. Talk about him.
Yeah, so Joe McGlade, the CEO there, he really took a hit more on the bonus side last year. And this is a trend we've been seeing for the last couple of years, is that companies are getting, these bonus targets are getting much more specific, and companies are really holding CEOs to them. It used to be that they would decide your annual bonus. They would say, well, you were supposed to do this, but it rained on Tuesday, so that was a bad thing, and we'll make it up for you. And these days, companies are setting numerical targets, and if you don't, the company doesn't hit them, then the CEO doesn't get his bonus, and that's what happened to McGlade last year. His bonus got cut, roughly by 2/3. Went from $2.5 million to less than $1 million. Overall, his compensation was down. I don't have the number right in front of me, but something like 15 to 20%. And so, I'm sure critics will say the system still isn't perfect, and I'm sure it still isn't. But there do seem to be these sort of nudges in the direction of keeping executives more accountable when they get these big paychecks.
Okay, and to be clear, by the way, it's more than just the 50 companies that we're looking at in this particular study, isn't it?
Yeah, so this is sort of our version of a sneak peek at our own CEO compensation survey, which we'll publish in May. And this is the trend that really popped out when we looked at it. But we think it's more than just these 50 companies. We saw examples last week at places like Johnson & Johnson, where they cut the bonuses for last year by 10%. There's a relatively new study out by one of the big pay advisors that shows that whereas 10 years ago, something like 20% of companies attached any kind of performance condition to these stock grants. They don't have last year's numbers yet, but by 2011, that number was up to 64%. So, there's pretty good evidence this trend is going on broader than just these 50 companies that we've looked at here. And we'll take another look at it when we get the full results of the survey in May.
Last, we've only got about 15 seconds, but on the opposite side of the spectrum here is, for instance, Larry Ellison at Oracle.
Yeah, he got a $90 million option grant last year because he only owns 20% of the company already. So, now defenders of options will say those are performance related too, because they only pay off if the stock goes up. But, we saw what happened 10 years ago when compensation schemes were highly leveraged around options.
Larry Ellison, it's interesting. Oracle stock did jump significantly in 2012, but as we'll talk about in our market segment coming up, it's not doing so well today. Scott, thanks so much for joining us.